Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's Tax and Financial Services over in Brentwood, Tennessee. She is a tax expert when it comes to individuals and small business owners. And if you have tax problems like with the IRS, hopefully not. Bad time of year for that, but if you want to get out from under
Believe it or not, they love to
the
send love
Scrooge
letters
thing there, you know, you might want to get some help from Dr. Friday. There's a lot of ways you can be helped if you've got tax bills to get those things reduced and eliminated, okay, get them paid. All right, you know, and I want to tell you, by the way, we've known each other for a lot of years, and we work, you know, with our clients, you know, back and forth as far as when it comes to tax planning. This is the other piece of it. Are you doing tax planning each year? Are you looking at what you're paying in taxes, or the things that you can do? As I mentioned, one strategy about itemizing every other year is an example where, you know, otherwise every year you would not be able to, and you would not be able to save as much on your taxes. I think this strategy is still going to apply. It's just going to be that the amounts are going to be a little different. You're going to get a higher standard deduction. So
the fact is, people that were on the verge of itemizing in the past. So if you were a married couple and you were taking $14,000 or $15,000 every year, and most of it was mortgage interest, you're probably not going to be able to take advantage of that kind. But we have a lot of clients that are extremely giving. I mean, these people love to help out the community and everything. Those individuals will still be able to maximize that type of service, possibly, you know, doubling up every other year for their contributions, doubling up their property taxes, and we'll be okay for the sales tax or state income tax because of the fact that most people are under $10,000 as a married couple.
And that's the other part. We'll go into a little bit on the brackets. We'll go over that a little bit real quick. So you're going to have a standard deduction is going to jump for an individual. It's going to go from $6,000 to $12,000. Married filing jointly, it's going to go from $12,000 to $24,000. Head of household, $18,000. So on that, no personal exemptions, but we're going to have some credits that are going to be available that can help make up for the loss of the exemption. And then depending on how much money you make, the phase outs on those credits, and then there's a refundable, non-refundable, right, portion of the credit cannot exceed, where'd it go? Non-refundable credit of $500, and this is on the child credit.
Correct.
So everybody's
going to, and there's still things out there I have to point out really quick that we don't know all the answers. For example, if you were a senior over the age of 65, is there a step-up basis? Right. There's nothing in here that's telling us yes or no at this point. So we're still working and learning about some of the new tax laws that will be signed into. Yeah,
specifically. So if you were over 65, you got an extra $1,250 this year in 2017 per. So let's say it's a couple, it'd be $2,500, or for an individual, it actually is $1,500. That would be added to your standard deduction, increasing it, plus the exemption. So it would push you up around, for a married couple, it would push you up around $23,000 typically. The new standard deduction at 24 kind of encompasses that. But for people over 65, we're not sure if they're going to maybe, you know, give us that added on. It does not show it yet in what we're seeing in terms of the analysis of it. Adjustments for capital gains taxation we were talking about there, that actually seems to be pretty much about the same as what it's been in prior years. They're just, instead of using a 10 or 15% bracket, they're using the income thresholds, but the end result is the same. Right. And this is one of those that's going to be kind of a big one. This temporary reduction in medical expense deduction, that's one of those where before you need a 10% of your AGI, your adjusted gross income, to be able to itemize with those medical. They've reduced that down for 2017 and 2018.
This is one of the few that they actually did backdate. So keep in mind, we're going to have a couple of those that you're going to see that got snuck in. So make sure when you go to your tax person this year that you spend just a little extra time making sure, because in the past, if you think, oh, it's 10%, I couldn't get there, even if I was close, then this is 7.5, so that's a big difference in some people, and they might be able to take some of their medical in 17, which is the year we're going to be doing.
This is one of those areas that, I mean, if you've got some cases that I'm working on, or cases that I have right now, these are clients that are going through different situations. One of them is when you think in terms of assisted living or nursing home care or possibly home health care. These are if this is medically necessary, these are able to be deducted, and now you've just got a reduction. That's more that you can deduct. Now here's a strategy that you can apply there. Then, if you've got money that's accumulated in, let's say, interest that's accumulated in annuities annuities or in retirement accounts, IRAs and the like, that
Right.
you can then pull out. These medical expenses could offset what would normally be taxable income to you, allowing you to get some of that income out so that it won't be taxable in the future. And this is, think in terms of, I'll give you an example. I've got one client who, I've got actually a few right now in this situation, but they're in assisted living. They've got high medical expenses. They had a lot of money that they had built up in taxable interest in some different accounts. And what we're going to be able to do is peel off some of that money, pay the tax now, well, no tax. It'll zero out with the medical expenses. There will be no then future taxation on that. The amount that's left is mainly going to be principal, but because of this year and next year, we're going to be able to take even more now advantage in taking even more money out and pay no tax on it at all. So imagine money that would have been taxed. And here's another thing. If that person, these are people that are getting up in age and they may not use this money, but we're at least able to wash out the taxes, so when it goes to their beneficiaries, their children, guess what? No tax for them either.
But I have to jump in because, again, this is a 17, so that means that somebody needs to be contacting you relatively, because you would have done tax planning based on 10%. It's what we knew the law to be. So you might still be able to draw another $10,000 out tax-free. You don't want to miss that window.
You got a short window.
So you really got
done.
very, very short window. So I'm putting pressure on Hank's office over there.
That way, come see us. We'll get you taken care of. All right, we got a caller. Ricky, welcome to the Retirement Report.
Hello.
Hi, how you doing?
All right, how are you?
Very good, thanks. How can we help this morning?
Is these tax laws going to apply to the 2017 taxes, or are they going to start the 2018 taxes?
For the most part, 2018.
Right.
There are some exceptions. That one we just mentioned was the medical deduction.
So you're going to have to
All
keep...
right, I appreciate it.
Thanks.
Okay, Ricky.
And again, you're really going to, I can't say it enough, you're really going to have to follow this show and some of the other shows that are out there, because we're finding more and more there is some things that they have backdated to 17.
And this is one of the things. We may not, like on this medical deduction, jumping in and seeing what the amount is that you can, seeing what that amounts to for you, and is there something you can do here in these remaining days to try to get that, get some additional money out, as an example, if you're employing this strategy, if there's ways to do that. The other part, there's not much we can do on the 2017 piece. However, when it comes to doing your taxes, filing your taxes this coming year for 2017, understanding how these rules are going to affect you and what you may, what you may benefit from it, or how to take advantage of certain things, and just understanding so you don't miss out on deductions. That's the biggest thing.
Well, yeah.
2018, and then doing planning for 2018.
When you go in to see your tax person, have the questions that okay, so 17 really hasn't changed, but we know 18's changed. So under the same exact scenario, for 17, what would have my taxes been roughly for 18? Because you may need to be adjusting your W-4. You might want to consult with your financial and say, oh, you know what, I can take a little bit more out because I'm in a lower tax bracket that I've been in for a while. So it's really important that this year, it's been 30 years since we've had serious tax planning.
Right.
Tax changes.
Yeah.
People hopefully have been doing tax planning a lot longer, but the change, so a lot of people are just doing the same thing always. They're not looking really, they're like, okay, nothing really changed, I'll do the same thing. This is the year you've got to wake up. You got to make some changes.
Yeah, charitable contribution. We're going to talk about a lot of this when we come back. We're going to take a quick break. When we come back, we'll delve into some additional things, what the new tax laws changes are, and what, if anything, as far as 2017, any other effects there, and of course then planning ahead for 2018. So join us here. We'll be right back on the Retirement Report.
On a very